Hi, my name is Moses, and I'm the lazy frugal millennial. Today I want to talk about retirement accounts. If you don't have a retirement account yet, then right after watching this video, you should go and open one right away. Planning for your retirement is one of the most important things that you can do in your life because you don't want to have to work for the rest of your life. But the only way that you're going to be able to retire is if you've been planning for your retirement from early on. I'll even include a link in the description where you can get $10 credit just for opening an account. I'm going to preface this video by saying that none of this information that I'm providing is tax advice or financial advice. Before you go and do anything, go and talk to a tax professional or a financial advisor to help you make your decision. When you're planning for your retirement, you have two main account types. You have the 401k and an IRA. Then on top of that, you also have Roth accounts and traditional accounts. We're going to go over all of that today. A retirement account is a very special type of investment account because it's a tax-free bubble. You don't get taxed on the events that happen inside your retirement account. When you invest in a traditional brokerage, every time you go to sell stock and you have a gain, you have to pay taxes on that gain. But you don't have to pay taxes on gains that happen in a retirement account. This can be a huge cost savings that helps your retirement funds grow even bigger. But that doesn't mean you don't have to pay taxes on that money. Uncle Sam still wants his cut. He's just going to get it different ways depending on what type of account you have. When you invest in a traditional retirement account, you're investing with pre-tax money, or money that you haven't paid taxes on yet. So if you put $1,000 in a traditional retirement account, the IRS is going to give you a $1,000 tax deduction, which means that they're taking $1,000 off of your taxable income. When you're in retirement age and you go to take money out of this account, you're going to be paying taxes on the entire distribution. So with a traditional retirement account, you're paying all of your taxes on the distribution side rather than on the contribution side. A Roth account is still a tax-free bubble, but you're going to be paying taxes on your contribution rather than your distribution. So if you put $1,000 into a Roth account, the IRS is not going to reduce your taxable income by $1,000. However, in retirement, when you go to take that money out of your account, it's completely tax-free. Another advantage of a Roth retirement account is that you can withdraw your contribution at any time without penalties or taxes. Since this is already post-tax money, or money you've already paid taxes on, if you put $1,000 into your retirement account, and this grows to $1,100, you can still take out your original $1,000, leaving you with $100 in your account. This can be very helpful and provide you some flexibility when it comes to emergencies or unexpected expenses. You should still never take money out of your retirement account though, it's just good to know that you can. So should you choose a Roth account or a traditional account? That depends on a lot of factors like your current income, your current taxes, how much you plan to contribute, and what you think your income is going to look like in retirement. There's a lot of moving pieces to this equation, so I'm going to link to a calculator in the description from NerdWallet where you can put in your own numbers and see which account might work best for you. Now let's talk about the difference between a 401k and an IRA. A 401k is a tax-advantaged retirement account provided by employers for their employees. The only way that you can contribute money to a 401k is by taking money directly off of your paycheck and putting it into a 401k. In 2020 and 2021, the contribution limits for a 401k are $19,500 if you're under 50, or $26,000 if you're 50 years and over. At many companies, there's a very special advantage to investing in a 401k account. Your employer matches your contribution. The amount of matching is going to vary company to company, but in many cases, they might even be doubling your contribution. So if you put in 3% of your paycheck, your employer will put in another 3%. Or if you put in 6% of your paycheck, your employer will put in another 6%. This is effectively doubling your money for doing nothing extra. So if your company offers 401k matching and you're not taking advantage of that, the next time you go into work, talk to your HR person or your supervisor and figure out how you can enroll in the company's 401k plan and enjoy their matching benefits. You're going to be increasing how much money you're making from work without doing any extra work. You're welcome. 401ks are typically managed by an outside company, and you're going to have to choose from one of their funds to invest in. You're not going to have a lot of control over your 401k, but if you're receiving contribution matching from your employer, then that alone makes a 401k worth it. On the other hand, you have IRAs, or individual retirement accounts. You can go to just about any broker and they'll offer you an IRA that you can invest in. In 2020 and 2021, the contribution limits for an IRA are $6,000 if you're under 50 or $7,000 if you're 50 and over. There's two different types of IRA accounts. There's robo-advisor accounts and brokerage accounts. If you're not so comfortable picking your own stocks, or you just don't want to manage an account actively, you can go with a robo-advisor account. You'll tell them what your expected retirement year is based on your age, and they will automatically put you in a risk-balanced portfolio for your age. So if you're young, they're going to put you in a bunch of risky stocks and small cap stocks rather than large cap stocks and bonds. This is a risky account, but since it's risky, it's also high reward. Since it's risky, there's also a higher chance of it going down. But since you're young, you're going to have a lot more time to recover from market downfalls when they happen. As you get older, they're going to be changing your allocation to more large cap stocks and bonds and less small cap stocks and risky stocks. This is going to give you a much more secure portfolio as you get closer to retirement. If you're more comfortable picking your own stocks, or you want to actively manage an account, then you should go with a brokerage IRA. In a brokerage IRA, you have complete control over this account. You decide what your money is going to do for you. If you think Tesla's going to the moon, then you can YOLO all of your money in Tesla and nobody's going to stop you. There's one more thing to talk about with retirement accounts, and that's how you withdraw your money. Eventually, you're going to have to withdraw money from your accounts, whether it's in retirement or for some other reason. So let's go over what that looks like for each account type. In a 401k, to be able to pull money out without penalty, you have to have what's called a trigger event. A trigger event is when you terminate your employment by either death, permanent disability, or you turn 59 and a half years old. This is the intended way for withdrawing money from your 401k account. If you have a traditional 401k, then you're going to be paying taxes at your ordinary income tax rate at the time on every single withdrawal. However, if you have a Roth 401k account, then the money is yours free and clear with no taxes and no penalties. The other way to pull money from your 401k account is through a hardship withdrawal, but you're going to have taxes and penalties for doing a hardship withdrawal. To qualify for a hardship withdrawal, you have to have an immediate and heavy expense. Unfortunately, that doesn't cover buying a yacht or a new car. But a few things that do qualify for a hardship withdrawal are medical expenses, buying your first home, up to 12 months of tuition, preventing foreclosure or eviction, burial or funeral expenses, or repairing your home due to damage caused by natural disasters. If you do a hardship withdrawal from a 401k account, then you're going to have to pay taxes on that withdrawal at your ordinary income tax rate. And on top of that, you're going to have another 10% penalty if you're under 59 and a half years old. According to the US Census, in 2019, the median home income in the United States was $69,000.
Nice.
At the federal level, that puts you in the 22% tax bracket. Then at the state level, on average, you're going to be paying another 4% in taxes. That means that if you have to withdraw $10,000 from your 401k account, you're going to be paying $2,600 in taxes, $1,000 in penalties, leaving you with only $6,400 to use. That's very painful, so pulling money from your 401k should absolutely be your last resort. A 401k account also has what's called a required minimum distribution, or RMD. When you turn 72, you're required to start taking money out of your 401k account, otherwise you're going to start getting hit with tax penalties from the IRS. The amount is going to vary person to person, but the way that you figure it out is by taking your account's ending balance on December 31st of the previous year and dividing that by your expected lifespan as defined by the IRS. This gets pretty tricky, but everything that involves the US tax code is pretty tricky. Let's say as an example, you have an account that has an ending balance on December 31st of the previous year of $250,000. You are 74, your spouse is the only beneficiary of this account, and your spouse is 11 years younger than you. Your expected lifespan is 22 years as defined by the IRS. So you would take $250,000, divide that by 22, and you get a required minimum distribution of $11,363. The IRS has a very helpful website that I'll link in the description. It's only 52 pages long, so go ahead and give it a read to get to know more information. An IRA works similarly. You can start withdrawing penalty-free when you turn 59 and a half years old. If you have a traditional IRA, you're going to be paying taxes at your ordinary income level at the time on every single withdrawal you make from this account. If you have a Roth IRA account, the money is yours free and clear with no taxes and no penalties. An IRA also lets you withdraw funds early, but you're going to be paying taxes and penalties on that withdrawal. However, an IRA offers a few ways that you can withdraw money without having to pay the penalty, but you're still going to owe the taxes. A few of those uses are higher education, which has no dollar limit, a home purchase, which has a $10,000 limit, the birth or adoption of a child, which has a $5,000 limit, or medical expenses if the medical expense exceeds 7.5% of your annual income. There's one big difference between a traditional IRA and a Roth IRA when it comes to the required minimum distribution. A traditional IRA has a required minimum distribution, while a Roth IRA does not have a required minimum distribution. If you're 71 with a traditional 401k, a Roth 401k, or a traditional IRA, and you don't want to have to start taking a required minimum distribution next year, the way that you can avoid that is by rolling your current account into a Roth IRA, and that would get you out of the RMD. However, when you do that, there are going to be a bunch of different taxes you have to pay for that rollover. So talk to a tax professional or a financial advisor before you do that. This was a lot of information, so to help you out, I'm going to go over how I invest for retirement to give you an idea of what's possible. I expect that over the next 40 years, my income will continue to rise, and I also expect that taxes will continue to rise, because why wouldn't they? So I invest in all Roth retirement accounts. When I was employed by a company, I had a Roth 401k account that had contribution matching. Then when I left them to go work for myself, I started a Roth IRA account with M1 Finance and rolled my Roth 401k into my Roth IRA. So I front load all my taxes on the contribution. That way my distributions in retirement are completely tax-free. According to the calculator on NerdWallet, based on my income, my taxes, and my contributions, in retirement I could end up with 50% more money by using a Roth retirement account rather than a traditional retirement account. So you should run your own numbers and see what it looks like in retirement. That way you know which account's going to work out best for you. You could end up saving a significant amount of money just by doing that simple exercise. Thank you for watching my video. If you enjoyed it, then please smash the like button and subscribe to my channel. And also leave me some feedback down in the comments to let me know what you think. And I'll see you on the next video.